Welcome to Accounting with MSL, and welcome to our video where I take you through a number of different questions that cover a number of different accounting standards. So we'll see some elements of IFRS 15, which deals with revenue from contract with customers. We'll end up seeing some elements of IAS 16, which deals with property, plant, and equipment. We'll see some elements of IAS 37, which deals with provisions, contingent liabilities, and contingent assets. And then we'll see some elements of IAS 10, events after the reporting period. So these are different standards combined into one huge question. So I think it's a very essential part of a revision for any exam you may be sitting, any financial reporting exam you're sitting. This should form part of your revision for that exam. So let's start without wasting any further time. So as usual, you read the preamble to the question and then you read the requirement. So what does the preamble say? You're telling us that Delta, so the name of the entity is Delta, is an entity which prepares financial statements to 30th September each year. So at least we know their year end or their reporting date is 30th September of each year. Right, they're saying each year the financial statements are authorized for issue on 30th November. If you remember your IAS 10, which is events after the reporting period, you realize that this is a clue the examiner is giving you, that even before you read the entire question, you are being told that there will be some element of events after the reporting period, because you know IAS 10 defines events after the reporting period to be any event that occurs after the accounting year end but before the financial statements are authorized for issue. So if a question gives you the year end of 30th September and gives you 30th November as the date on which the accounts are authorized for issue, at the back of your mind, you should know that they are hinting that there's some element of IAS 10 in this question. Let's continue. So during the year ended 30th September 2014, the following transactions occurred. So we know the transactions below will deal with the specific year of 30th September 2014. Perfect. Now let's go to our requirements. I can see we have three things: A, we have B, and we have C for 9 marks, 8 marks, and 3 marks respectively. So what's our requirements? Required is to, number 1, explain, and number 2, show, where possible by quantifying the amounts, how the 3 events would be accounted for in the financial statements of Delta for the year ended 30th September 2014. And be careful, they said in the financial statements. So they are not just saying, tell me the income statement income statement impact on the balance sheet impact. Tell me the impact on as many financial statements as you can, really. I mean, the essential ones for the particular standard involved. And we need to do this for a number of marks. We've been told that the mark allocation is shown against each of the 3 events above, and you should assume that all transactions described here are material. So you cannot say because you think a particular transaction is immaterial, you're not going to consider the impact on the financials. So stick with me to the very end, and I will break this down for you to the barest level possible. Make sure you understand this and ensure that your appreciation or your understanding of these accounting standards is even improved a lot more. So this is an ACCA past exam question from the Association of Chartered Certified Accountants. So let's start. Let's look at question A. They are saying that on 1st October 2013, so in accounting, every single date they give you matters. So we've been told that on 1st October 2013, something happened. What was that something? Delta sold a machine to a customer for a total price of 500,000. So we know that Delta has done some selling. What did they sell? They sold a machine. Okay. Total price $500,000. Delta invoiced the customer for $500,000 on 1st October 2013. You can see the same date on which they sold the machine. So it means on the same date they sold the machine, they issued an invoice to the customer. And they are saying the customer made a payment of the same $500,000 to Delta on 15th October 2013. So same month, approximately 15 days later, the customer made full payment of the invoice amount. Okay, let's continue. The terms of the sale included an arrangement that Delta would service and maintain the machine for a 4-year period from 1st October 2013. Also, we've been told here that Delta would normally charge an annual fee. So let's do some highlighting actually. So what we know so far is that the machine cost $500,000. They sold it on 1st October 2013. And the customer made payment on 15th October 2013. The terms of the sale, okay, included an arrangement that Delta would service and maintain the machine for a 4-year period from 1st October 2013. Right, let's continue. We've been told that Delta would normally charge an annual fee of $37,500 for a service and maintenance arrangement of this nature. So it means that Delta typically would service and maintain your machine for you at $37,500 every year if they were to have a standalone arrangement with you. Okay, we've been told also that the normal selling price of the machine without, take note, without a service and maintenance arrangement was $450,000. So we have two critical pieces of information here. We have $37,500 being the price per year. Take note, it's a per year amount because it said annual. So annual fee of $37,500 for a service and maintenance arrangement. And then if they sold the machine without any maintenance arrangement, it will cost you $450,000. So all the examiner has done here is they gave you this information and left you in the dark to wonder what to do. But here, let me tell you the principle they are testing. Let's quickly revise our IFRS 15. If you remember, IFRS 15 proposes or has something we call the 5-step model to revenue recognition. What does a 5-step model mean? The 5-step model is essentially the core principle underlying IFRS 15 revenue from contract with customers. It is those 5 steps we go through to determine and allocate revenue from different contracts entered into by a business with their customers. Quick recap, quick refresher. The 5-step model, step 1 is for you to identify the contract with a customer. So your step 1 is to identify the contract that you have with a customer. Step 2 is to identify the performance obligations in the contract. Step 3 is to determine the transaction price. Step 4 is to allocate the transaction price that you determine in step 3. So allocate the transaction price to the performance obligations in the contract. And then finally, step 5 is to what? Recognize revenue as and when each performance obligation is satisfied. So be very, very mindful of this. This is what IFRS 15 is all about, the five-step model. Obviously, there are other rules and principles in the standard, but this is central. First thing you need to do is identify the contract. What contract do you have with the customer? So what the examiner is doing essentially is to test point number 2 and then 4, actually 2 to 4, right? Actually the whole thing, because apart from the contract that we're going to identify in step 1, we need to know what the performance obligations in this question are. We need to know the transaction price. Then we need to allocate the price to each obligation. So here, first thing is to identify the contract. Next is identify the performance obligations. What must you do? What are your roles? What are your obligations under the contract? The next is to determine the transaction price. What consideration have you both agreed on as part of the contract? Step 4 is to, remember we did in step 2, we identified something called a PO, a performance obligation. In step 3, we determined something called a TP, a transaction price. So step 4 is simply allocate your TP to each PO in the contract. Obviously, if you have a contract that has just one performance obligation, so if you enter into a contract with a friend to deliver goods, let's say mangoes to her or oranges to her, that contract has just one performance obligation, so there's no need to allocate the transaction price. If you agree on $1,000, that is a transaction price for a contract that has one performance obligation. But where the performance obligations are more than one, you need to allocate the transaction price you've agreed on to each obligation. And final step is what? Recognize revenue as and when you satisfy each obligation under the contract or each performance obligation. So with this knowledge or with this revision of the five-step model, let's come back to this question. Let's do some exercise. So here, Delta has sold a machine to a customer for $500,000. So can we all agree that this $500,000 is the TP, the transaction price? Agreed? So the transaction price is, so we've done step 3 really, which is what? To determine the transaction price, $500,000. Okay, let's keep going. Then if you come here, terms of the sale, that is where you typically find your performance obligation. That's what will tell you what you've both agreed to be bound by or bound with under contract law. So the terms of the sale here will be saying that Delta has promised that apart from selling the machine to the customer, when you pay me this $500,000, I will also service and maintain your machine for you every year for 4 years. So it means the $500,000 is something we'll call a bundled amount. Bundled means what? The $500,000 includes both the cost of the machine and the cost of servicing, but Delta has packaged everything into one amount and discharged that part of the contract. So here we know that we have two performance obligations. Take note, we've determined our TP, our transaction price, to be $500,000. We need to determine our POs, our performance obligation. The first one is what? The sale of a machine. So our first PO is what? This one. So PO1, which is what? When Delta sold the machine. So Delta sold the machine. That is the first performance obligation, which is to deliver a machine to the customer. Give them a physical machine. If it's a computer, if it's any other machine, that is the first performance obligation. Once you deliver that machine to the customer, then you've satisfied your first performance obligation. The next performance obligation, which will not be satisfied immediately but over a 4-year period, is to service and maintain the machine. So we'll call that a service and maintenance agreement. So that is what PO2, performance obligation 2. So this contract that Delta has entered into with the customer has two performance obligations. First one is the sale of a machine, and the next is what? The rendering of services towards service and maintain the machine that they've sold to them for 4 years, all as part of what? The TP, or the transaction price of $500,000. So coming back to our 5-step model here, we have identified the POs, agreed, let me use this instead. We have identified the POs. We have determined the TP. We've obviously identified that as a contract. So let's come to step 4 here, which is what? We need to allocate the transaction price to each performance obligation, right? So let's start the question really. So let's begin to solve the question and answer it like we would in an exam. This on the right here was just to help you revise your 5-step model. So let's continue. All right. So question A. Let's remind ourselves what the examiner said. They said explain and show. So the first requirement is to explain and show where possible by quantifying the amount. So you need to do some computational elements. How the 3 events will be accounted for in the financials for the year ended September 14. Remember, we don't need to go beyond 2014. So let us begin. Now that we've identified this issue, we need to state, so this is an exam, this is how we write. Say IFRS 15 revenue from contracts with customers prescribes a 5-step model to revenue recognition, full stop. So this is not where you're going to school the examiner on the full 5-step. Go straight to the point. So we say the second step of the 5-step model under IFRS 15 requires an identification of the performance obligations in the contract. Okay, so we've made this point. So we say under Delta's contract with the customer, there are 2, let's say make it 2 separate. There are 2 separate performance obligations. So you agree with me that we identified PO1 and then we identified what? PO2. So we say these are, let me get some more space. Okay, so these are A, the supply or the sale of a machine, and then B, the supply or the provision of service, let's make it servicing and maintenance of the machine. So we've made our point clear right here that there are 2 different performance obligations. One is to supply or to sell a machine to the customer, and the next is to what? To supply or maintain, to service and maintain the machine. So the next thing is, say, under the 4th step of IFRS 15's 5-step model, the transaction price of $500,000 would have to be allocated to each performance obligation above. This is as shown below. Agreed? So you've told the examiner what you're going to do. Now let's go ahead and actually do it. How do we allocate the performance obligations to, how do we allocate the transaction price, right, to the performance obligations? If it comes to the question here, we've been told that we sold the whole thing for $500,000, right? Usually in a question like this, the examiner will give you something called the standalone, take note, standalone prices. What this means is that if you were to sell a machine alone without any servicing, how much will it cost? If you were to service a machine separately without selling a machine to the person, how much would you charge for that? So you need the individual standalone selling prices to allocate. So let's do this. We say total transaction price equals what? $500,000. We need to also talk about what? Standalone price for sale of machine equals what? We're told here that watch here, last sentence, the normal selling price of the machine without what? A service and maintenance. It means if you sell a machine without the agreements to service for 4 years, it will cost them what? Right here, $450,000. So this equals $450,000. All right, so we know the standalone price for the sale of a machine. So let's also find the stand-alone price for what? For a service and maintenance agreement equals what? They said 37,500, right? But this is going to be done for 4 years. So it's going to be 37,500 times 4 years. So let's multiply, calculator. So 37,500 times 4 gives me $150,000. So it means my standalone price for the sale of a machine is $450,000. If I was buying a machine and I told you I didn't want any service, keep your service, I want just a machine, it would have gone for $450,000. If I came to you and said, I have my own machine, just come and service it for me, it will cost me $37,500 every year. So over the 4 years, it will cost me $150,000. So what we need to do is to use this standalone prices to allocate the performance obligations to this transaction price of $500,000. Simple. How do we do this? We're going to use ratio and proportion, really. So this is how you do it. So sale of machine is simply going to be, in fact, let's do this first. Let's find the total because that's what we'll be using. So let's just say total standalone prices will be what? 450,000 plus 150,000. Obviously that will give us $600,000. So it means that the total standalone price is $600,000. So now we can do the allocation. Let's find the transaction price that will allocate to the performance obligation of what? The sale of a machine. So we say sale of a machine will equal, what is the standalone price for machine? 450, right? So it will equal $450,000 divided by the total right here of $600,000. So divided by $600,000 times, what are we trying to allocate in the first place? It is this $500,000 here, right? So times $500,000, 500,000. What would this give you? So calculator, 450,000 divided by 600 times 500,000. That gives me $375,000. So it means the revenue I will recognize from the sale of the machine in this contract will be $375,000. Don't forget that under IFRS 15, the final step 5 is to what? If you remember right here, I told you step 5 is to recognize revenue as and when each obligation is satisfied. So you need to find the revenue for each obligation separately. Then as and when you satisfy, you recognize revenue in the books. So we know that for the machine part, the revenue is 375. Now let's look at the service component. So the service and maintenance agreement, same procedure. What is the standalone price for that? We have here to be what? 150,000. So it's going to be 150,000 divided by what? The total of what? Right here, 600,000. So divided by 600,000. Then times our 500,000 total transaction price. So this will give us 150,000 divided by 600,000 times 500. Obviously, you could have subtracted from 500 to get a difference, but we're just trying to follow procedure. So this will give us $125,000. So what I've done is I have allocated the transaction price to each performance obligation. Now that I've done this, let's do the proper accounting, because they said we should say how accounting will be done. So let's write. We'll say the revenue in the books of Delta would therefore be recognized as follows. So what will I do? Remember that you sold the machine. So let's come back to the question. I sold the machine on what? 1st October 2013. So on 1st October 2013, I have sold the machine. I need to recognize revenue from the sale of machine of how much? 375,000. So we say on 1st October 2013, $375,000 would have to be recognized on the sale of the machine. So here, I always say students who know what they are doing would always use double entry. So we know revenue is a credit item. So I will credit my revenue. So I'll credit my revenue with 375,000, right? Then what do? I will debit. But be careful. On 1st October 2013, what happened? The customer, they are saying you sold the machine for $500,000. So clearly, you have entered into a transaction. So you have to, let me even write this properly. Let's use the narration. So let's take this again. So I'll credit my revenue with 375,000. Good. Then they said I sold to the customer for 500,000 and he paid me 15 days later. So it means as at 1st October 2013, as at this particular date, the customer has not paid me cash. So I have to debit my receivables, my asset of receivables of how much? $500,000. This clearly tells you that as at 1st October, there's a balance outstanding. And ladies and gentlemen, we call this balance deferred revenue or deferred income. So we need to credit deferred income of the difference of what? 125,000. So don't forget that in accounting, double entry, your debits should always equal your credits. So if you've sold something for $500,000 as at 1st October and the person has not paid you cash, clearly you have to debit receivables. But you cannot debit revenue of 500,000 because under IFRS 15, the revenue from the sale of the machine is only what? 375,000. The remaining part of 125 is deferred, and as you can see from here, we've said clearly that this 125,000 refers to what? The service and maintenance agreements, which will be delivered over a 4-year period. So you cannot recognize revenue until you have gone to actually service each machine at the annual period for 4 years. So what is due as revenue will be what? 375,000. So now we've said what will happen on 1st October 2013, right? So let's continue. Let's come to the next stage in the story, which is what? 15th October from here. 15th October 2013. So we say on 15th October 2013, when the customer made payment, what will happen? When they make payment, we no longer have what? A receivables figure, because don't forget they paid us what? $500,000 in full. So what we do? If they pay us in full, clearly they paid us either by way of cash or they made a bank transfer, whichever. So what will I do? I will debit my bank or cash, anyone, with the $500,000 they paid me on which date? On this 15th October 2013. Then I have to clear my receivable balance to zero because they don't owe me again. Then I credit my receivables with $500,000. So we are done with the 15th October. So if you look at the question carefully, nothing happened until year end. So now that they are saying that we need to actually service the machine every year for 4 years, this will happen. Watch the question carefully. They are saying we'll service and maintain the machine for a 4-year period from 1st October 2013. So it means that the first service is due this year. So we'll say that as at, what's the year end? 30th September 2014, the revenue for the service and maintenance portion of the contract would be recognized as below. So don't forget that we have a figure of what? 125,000 here, which is for the full 4 years. So if you're going to allocate for 4 years, it's going to be what? First year is 1/4 times this 125,000. So it's going to be 1/4 times 125,000. So my calculator, 1/4 times 125,000 will give me 31,250. So it means I will have to recognize 31,250 as revenue in the first year from the service component of the contract. How will I do this? Let's use double entry. Remember that we had what? 125,000 sitting under what? Deferred income as a credit. So we need to remove that figure and take it to revenue on the what? Income statement. Please take note, deferred income is a balance sheet balance. So this will be on what? The statement of financial position, right? So we need to debit deferred income to reduce the amount on the balance sheet by what? 31,250. Then we credit revenue on the income statement with what? 31,250. So this will make our revenue 31,250. So we can say that what? We say, therefore, total revenue from the contract for the year ended 30th September 2014 will be what? Two things. This 31,250 being 1/4 of the service and maintenance plus what? The amount recognized for the machine, which is what? Right here, 375,000. Remember, we allocated 375, right? Here. So our revenue for the year from selling this machine is 375 when we sold the machine upfront, and then 1/4 of the service and maintenance. So it's going to be 31,250 plus, what's the figure again? 375,000. So plus 375,000. So this will give us, I think, 406,250. So on your income statement, under the revenue line, this will be the revenue from contract with customers for the year, 406,250, being what? The full amount allocated to the machine sale and 1/4 of the revenue from the service and maintenance portion. But we are not done. They said we should give them what the figures will be on the balance sheet. So let's do it, right? So now we've spoken about the total revenue here. This will go to what? The income statement, right? So let's look at the balance sheet. So all of this 40,000, 406,000, sorry. Oops. So this 406,000 will go to the income statement as what? Revenue for the year. Now let's look at the statement of financial position. So we say on the statement of financial position, what will happen? Remember, we have some figure here. Remember, we had what? Deferred income of 125,000, which we said would be on the balance sheet. But do you remember that out of this 125,000, I have recognized what? 31,250 here as revenue for the current year. So it means it's the balance that will be on the balance sheet. So we say on the statement of financial position, deferred income balance will equal what? Our 125,000 minus what? 31,250. So 125,000 calculator minus 31,250 should give me 93,750, right? But if you want to do an excellent job, you can even break this down further. So we say, so out of this deferred income balance, we can say current liability portion will equal what? Remember that every year we are going to do what? This 1/4 of 125,000, which gave us 31,250. So it means, a current liability is what is due within the next 12 months, right? So the current liability portion will be the next 31,250 we have to pay in year 2. So the current liability portion will be what? 31,250. Then our non-current liability portion will be the remaining balance for the next 2 years after we pay the year 2 figure. So non-current liability portion will equal what? Essentially, it's going to be 125,000 minus year 1, 31,250 minus the one I just did here under what? Current liabilities of what? Also 31,250. So essentially 125,000 calculator minus 31,250 minus 31,250 will give me $62,500. So this is dollars. So essentially, on the balance sheet, I'll have under non-current liabilities 62,500. I'll report under my current liabilities 31,250. On the income statement, I'll record revenue total of 406,250 right here. If you want a breakdown, it's essentially what? Revenue from the sale of machines of, where is it? 375,000, this figure here. And then what? Also revenue from the service and maintenance contract, not 125, but what? Apportioned version of what? This one, 31,250. So that's going to be it for this question. These are the things that you need to show in the account. Remember, in the income statement, you show revenue from the full contract amount for the sale of the machine and the current year portion, because in year one, you only recognize the portion that you've done. Then the liability will be shown on the balance sheet. But I'm saying some students can just put this figure here of 93,750 as a liability. But you want to be an excellent student, so go a step forward and break it down into what? The current liability portion and the non-current liability portion. If you can do this, you are definitely scoring the full 9 marks allocated to this question. So if you can do all we've done, you are definitely scoring all the 9 marks here, right? So this is a perfect example to practice when it comes to IFRS 15, revenue from contract with customers. Let's do the next example. Question B. Here they are saying on 1st October 2013, Delta completed the construction. So I need this. So completed the construction of an ecologically efficient power station at a total construction cost of $40 million. The useful life of the factory at 1st October 2013 was 40 years. Under the terms of the operating license granted by the government, Delta is required to dismantle the power station on 30th September 2053. So let's ask ourselves, how many years is this? Don't forget we are in 2013. Luckily, it is 30th September and 1st October. So 2053 minus 2013, I think that should give you 40 years. Yeah. So this is a 40-year period we are looking at. All right. And return the land to its original state. The latest estimated cost of this process at 30 September 2053 prices. So this is future value amounts in the future, right? Is 55 million. An appropriate discount rate to use in any relevant calculation is 5% per annum. At this discount rate, the present value of $1 receivable in 40 years is 14.2 cents. This is for 8 marks. Also a loaded question. What is this question seeking to do? It's seeking to do a number of things. If you remember, under IAS 16, property, plant, and equipment, remember the standard said that items of property, plant, and equipment are required to be initially recognized at cost. And under cost, IAS 16 specifically told us that the cost of any dismantling required as part of what the asset will have to be added to the cost of the asset. IAS 16 further went on to tell us that any such estimate will be what? The present value of any, or the discounted present value of any future costs. Then if you go to IAS 37, provisions, contingent liabilities, and contingent assets, it tells us that such dismantling costs must be reasonably or reliably measured as what? An estimate, which will be, once again, the discounted present value of any future costs. So if that is the case, we've been told that the construction cost is $40 million here. So that's the cost of the PPE. That's not in dispute. We've been told also that the useful life is 40 years. We might need that for depreciation. We've been told that they will be required to dismantle the power station. So we know that there will be some dismantling provision that we must add to the cost of the asset. That will have to be done at 2050 or in 2053, 40 years from now. So we know that our period of discounting is going to be 40 years. We know that the cost in the future value terms is 55 million. So that's what we'll have to discount. And we've been given a discount factor of 5%. And luckily, they've given us a present value factor to be 14.2 cents. So that's $0.142. So with this, let's begin the question. Remember, let's remind ourselves of the requirements. They said we should what? Give me a second. They said we should explain and show how the event will be accounted for in the financial statements. So let's begin to solve this as well. Okay, so B. So here what are we required to do? We've been told that what the construction cost is 40 million. So let's go straight to the point. Delta's construction cost of 40, should we do millions or figures in thousands? Okay, of $40 million, right, will be capitalized as an asset under IAS 16, property, plant, and equipment. So there's no issue with this one. So obviously this was on 1st October 2013. Okay, we've made our point. Then we'll say regarding the cost of dismantling, this amount would have to be discounted to present value as prescribed under IAS 37, which deals with provisions. So let me just shorten it. Provisions, contingent liabilities, and contingent assets. And under IAS 16, which deals with property, plant, and equipment. Okay, so how do we do the discounting? This is simple. All we need to do is, technically, it's going to be the future value times any discount factor. So we say this will equal, let's even write a small formula, future value times what? Discount factor. So what's the future value? It was given to us here, if you can see, as what? 55 million. So we can just say dollars 55,000,000. What's the discount factor? We've been told that the present value of $1 receivable in 40 years is 14.2 cents. So all we can do is we can what? Say times 0.142. That's what it means technically. So let's multiply 55, 123, 123 times 0.142. That gives me 7,810,000. So this is the present value of the dismantling costs, right? So if this is the present value of dismantling costs, what does the standard say? It's saying that we need to recognize this as a provision and add it to the cost of PPE. So we say this dismantling cost, present value discounted will be recorded as, obviously it's a provision, so you credit the provision for dismantling of what? 7810000. So this will be on the balance sheet under your liabilities. Then where does the debit go? If it was an ordinary provision, you'd have debited the income statement with what? An increase in provision line, which would be an expense. But here, because IAS 16 has clearly said that we need to add such discounted provisions to the cost of an asset, we will have to what? Debit property, plant, and equipment with 7810000. So this will go and add up to the cost of the asset. So we say, therefore, the cost of the PPE as at 1st October 2013 equals what? The 7810000, this figure, right? Plus what? Our original assets cost, which we had to be 40 million right here, right? So okay, so plus 40 million. So clearly this will give us what? 47,810,000, right? So this will be the cost of the asset. Remember that we have discounted to present value the provision for future dismantling and added to the cost of the asset. So this is the total cost of the asset that we use for depreciation and for every other thing in this question. So we say for the year ended 30th September, remember that's our year end, 2014, Delta's depreciation charge would be what? We know simple depreciation equals what? Depreciation equals what? Cost minus residual value all over what? Useful life. This question did not give us any residual value, so we just take the cost of what? 47,810,000 minus 0 residual value over, remember they said the useful life right here is what? 40 years, so divided by 40 years. So 47,810,000 divided by 40 will give me 1,195,250. So this is my depreciation charge for the year, right? So this will go towards the income statement as my depreciation charge for the year. So what will be the carrying value of my asset on the balance sheet? So we say what? Carrying value of PPE as at which date? As at 30th September 2014 will equal what? Remember IAS 16 defines carrying value to be what? The cost of an asset less any accumulated depreciation less any accumulated impairment losses as determined under IAS 36 impairment. So what is the cost of the PPE? We have what? 47,810,000 minus depreciation of what from here? Minus 1,195,250. So calculator, what does that give us? So minus 47,810,000 I have 46, 614. So 46, 614, 750. So this will be the cost of the the current value of the asset on the balance sheet. So this will go on the statement of financial position under my non-current assets for the year, right? Final thing, and then we are done. Not final thing, really. When it comes to anytime there's a present value computation, most students forget something called unwinding cost. It's called unwinding cost because don't forget that you've taken a future value and you have brought it to the present. So this figure was 40 years away from us. We have endeavored to bring it to the present value 40 years ahead. So what you need to do is every year, you need to unwind the figure by the interest amount such that technically the whole idea of unwinding is to increase the provision amount so that by the time year 4 arrives, the figure you have on the balance sheet will not be the present value of what did we get? Will not be the present value right here of 7.8. No. By the time you get to year 40, the provision on the balance sheet should be the 55 million. And how would you do that? With the use of what? Unwinding. So we say each year unwinding interest would be computed as follows. So it's simply what? Take the provision amount and multiply by what? The interest rate or the discount rate. So what did we get as a provision? We got what? Right here, 7.8. So 7810. So we take 7810000. Do you remember the interest rate was given to us here as what? 5%, right? Per annum. So times 5%. What does that give you? So calculator 7810000 times 0.05. This will give me 390,500. So this figure is going to be a finance cost. By finance cost, I mean it will go to P&L. So I will debit finance cost in the income statement with 390,500. So this will go to the income statement. Then I will credit my provision for dismantling with 390,500. So remember I told you unwinding cost will increase the provision amount year on year until by the time you get to year 40, you have your full 55 million. So this will increase the provision by 390,500 by the end of the year, and then this 390,500 goes to the income statement as an expense, finance cost. So if we've done this, what will be the provision? So we say following from the above, the year end, that is the 30th September 2014, provision figure will give us what? What did we have? Initially, was supposed to be I think it was 7810000, right? Plus this unwinding interest we just computed. Because don't forget, we say we are going to what? We are crediting provision for dismantling. Crediting means you're going to add to the provision. So plus 390,500. What does that give you? So plus 390,7810000. This will give me 8.2 million. So I have 8,200, 500. So this will be the provision figure on the balance sheet for the year as at year end. So this figure will be shown on the statement of financial position, the balance sheet, as what? A non-current liability. So that's it for this question. it's not too complicated, but you need to remember the key learning points here. Remember that you need to discount to present value, add it to the cost of the asset, and then every year remember to unwind and take the finance cost to P&L. In most exams, the examiner's report always says students forget about what? Unwinding interest. So please be the excellent student and remember to what? Unwind your interest anytime you discount. And the good thing is, in accounting, once you know your stuff, your principal runs through. So if we get to consolidations, I'll show you where there is deferred consideration, where the parent acquires a subsidiary and promises to pay a certain amount in future. You know the principle in IFRS 10 and IFRS 3 is that we discount to present value. If you discount to present value the consideration to compute goodwill, at the end of the year, you need to unwind interest again, right? So it's the same principle, the same rule in that situation. So here, remember that what our key things we need to remember is that the cost was 40 million. Based on that, we had to discount the 55 million to present value to get 7.8. Then we added the 7.8 to the cost of the assets of 40 to get what? 47 million. Then that 47 million was depreciated over 40 years to get 1.1 for the year. Based on depreciation, we subtracted from the total of 47 to get 46 to be the current value of the asset for the year. Then we did unwinding interest to get 390,500. This 390,500 went to increase the provision. So our provision ended up being 8.2 and not 7.8, right? So please remember this and practice the question yourself to see if you are very good with the principles. So let's do our final question and then we can wrap up. The final one is actually more important, I guess, than the ones we've done so far. So C, they are saying on 5th May 2014, Delta was notified that a customer who is called Chi, right, was taking legal action against Delta in respect of financial losses incurred by Chi. Chi alleged that the financial losses were caused due to the supply by Delta of faulty products on 30th November 2013. Delta defended the case but considered, based on the progress of the case up to 30th September 2014, that there was a 75% probability. Remember? Very important figure here. They would have to pay damages of $20 million to the customer. The case was ultimately settled by Delta paying damages of 18 million to Chi on 15th November 2014. This is for 3 marks. It should tell you something. They don't want you to write an essay on IAS 10, IAS 37. No. 3 marks means it should be something very short. In exam, if it's 9 marks, ideally you should be making 9 unique points to score your 9 marks. So you can see I was trying to make separate points when we started. 8 marks means there are a number of things that go in. So everything I've done here should give me my 8 marks because I did separate things, gave the double entry and all of that. So what will I do under this final question? It's 3 marks. It should tell you something. The work required is very minimal. So here the whole idea is, remember, let me show you something. Let's come back to the top here. What did they tell us? They said that the year end is what? 30th September. We know this clearly. But each year, the financials are authorized for issue on 30th November. So if you remember your IAS 10, you know that under IAS 10, which is event after the reporting period, we have 2 types of events. We have something we call, so IAS 10, we have something we called adjusting events, and we have something called non-adjusting events. To provide you with a quick summary, IAS 10 says adjusting events are events that provide further evidence of a condition that existed as at year end, whereas non-adjusting events do not provide further evidence of any condition that exists as at year end. What does this mean? It means that if by the time the financial statements are being authorized for issue, you discover any additional information that only provides further evidence of something that was already existing as at year end, then it's an adjusting event and you need to adjust for it in the financial statement. Can we not say, therefore, that this court case is an adjusting event? Because watch this carefully. As at 30th September here, Delta themselves said there was a 75% probability. That is very likely. It's close to very likely. It's close to very probable, right? That they'll have to pay damages of 20 million to the customer. So a provision will be required as at what year end of 20 million. However, on 15th November, take note, 15th November is before 30th November here. So it is within the period where you can make adjustments under IAS 10. So under IAS 10, we need to adjust the provision to 80 million. So let's write, and that's what I mean. Okay. So the final one. Okay. So C. We'll say Delta would have to make a provision as at year end due to the conditions in IAS 37 being met. What are the conditions? It should be probable that what there will be a liability or there will be an obligation to that will lead to an outflow of resources. So here they sold goods that were faulty, and because of that past event, they had incurred an obligation now. So there is a clear reason for them to make a provision. If that is the case, then we need to clearly make the provision. So we've said this. So we say, let's do it this way. So let me clean this. We say initially, Delta would have made a provision for legal damages of how much? $20 million. However, since this is an adjusting event under IAS 10, events after the reporting period, Delta's final provision figure should be adjusted to the 18 million figure under the court settlement. All right, so take note that they are saying that the payment was ultimately made on what? Look at the date, 15th November. By 15th November, we would have closed our books, right? Because the year end is 30th September. So we say that as at 30th September, this 18 million figure would be recognized as a current liability. Why? Because what? You would have to settle it within the next 12 months. And in fact, technically in this case, it was within the next 15 days, really. So that is it. 3-mark question. You shouldn't try too much. This few points and you're done. Remember that here we've tested a number of different standards in one question. If you can do this, ladies and gentlemen, you would score a lot of marks. Actually, you score 20 marks to be specific. So that's it for this question. Hopefully it's been helpful. We've covered a number of standards. So if you love this video, which I suppose you do, don't forget to smash the like button. It means a lot to us. And don't forget to share this video within your entire network. I'll catch you in our next video.